Good morning and welcome to today's webcast, the impact of 2022 R&D Expense Capitalization Requirements. Before we get started, I'm going to play a brief housekeeping video.
Welcome and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, Travis, I'll turn it over to you to get us started.
Great. Good morning, everyone, or good afternoon if you're in the Mountain, Central, or Eastern time zone. My name is Travis Riley. I am a partner here at Moss Adams. I've been 100% focused on R&D tax incentives over the past 17 years. I work with a lot of different clients across many different industries, and I've been spending a ton of time, especially over the past couple months, working with our clients and trying to help them figure out how they're going to be impacted by R&D capitalization. Also working with them to help them figure out how do we plan around this. So this, as you all know, this is a huge topic right now. That's why you're all here. And we're hoping to share some of our knowledge with you and help you navigate this issue here today.
Good morning, everyone. I'm Star Fischer. I am also a partner in our R&D Tax Services group. I have been with Moss Adams for 22 years this year and been doing R&D for about 20 of those. Also, like Travis, work across all industries with a focus on manufacturing and consumer products, but have worked in all industries. And also, like Travis, we've been working together trying to figure out this 174 change and how it will impact all of our clients. So happy to be here with you today, and I will turn it back over to Travis to get started.
Great. All right. So just wanted to spend a moment talking about today's agenda. So as you can see here, we've divided the presentation into 4 parts. First, we're going to lay the groundwork, and we're going to give you some background about R&D capitalization and Code Section 174. Then we're going to move on and talk about some of the specific types of expenses that you'll have to start capitalizing starting in tax year 2022. We're going to move on from there. We're going to talk about some of the similarities and some of the differences between Code Sections 174 and 41. Then we're going to wrap up the presentation talking about some technical issues and some industry specific considerations. So we realize this is a very technical area of the tax code. We're going to start off at a high level, then we're going to get into some of the details, but we won't have time to cover every single issue around this topic. There's just too many of them. And so I also wanted to note that the rules, the way the rules apply, it can be different, very different from company to company. So it's important to realize that what we're talking about today, the rules as they stand, are as of January 24th, 2023. So the IRS, they could drop new guidance, or Congress could issue some kind of retroactive delay in the coming months. And that's something that we're all hoping for. But everything is kind of a moving target right now. Also, so today we're using a lot of tax terminology. We're talking about various code sections. So I just want to clarify that 174, code section 174, refers to the concept of R&D capitalization, while section 41 refers to the R&D credit. So two different code sections that we're going to be going back and forth talking about. Also, the term R&E, or research and experimentation, that's a term that's more generally tied to section 174 and R&D capitalization. And then the term R&D, or research and development, is typically more aligned with section 41. So we could use some of these terms interchangeably today. I may just say research expenses, that would kind of cover both, but just wanted to lay some of the groundwork for you there. So setting the stage, history and legislative updates. All right. So to understand R&D capitalization, we need to go back in time. And we need to go way back to origins of the tax code. So, I mean, this goes as far back as the Civil War timeframe. And I think back then the tax code was temporary. And then it reappeared again in 1913. And in 1913, that's when we have the permanent tax code, income tax code. So back during that time frame, we're talking over 100 years ago, there was just a ton of uncertainty in how taxpayers were supposed to account for their R&D. There weren't any tax provisions that addressed the treatment of research expenses. So taxpayers could deduct them as an ordinary business expense, or they could capitalize and amortize them over a useful life, or they could deduct the expenses if they had a project that ended up being abandoned. But it created some problems. If you couldn't determine a useful life, or if you never abandoned a project, then there really wasn't a way to account for your research costs. So we fast forward in time all the way up to 1954, and that was the first significant revision of the tax code. That's almost 70 years ago. So 1954 is when Congress addressed this whole issue with the enactment of Code Section 174. Code Section 174, it gave companies two options. So they could either deduct all their research expenses right away, or they could spread the costs out over a period of at least 60 months or 5 years. And so that eliminated a lot of the uncertainty around the tax treatment of research expenses. And for the past 70 years, that's essentially the way it's been. There have been some evolutions of 174 over that time frame, but I think for the most part, a lot of those changes were very taxpayer friendly. And as we move in here to the next slide, you'll see that the more recent changes with the Tax Cuts and Jobs Act, I wouldn't necessarily characterize these changes as being taxpayer friendly. So let's fast forward to year 2017, just a few years ago, with the Tax Cuts and Jobs Act, commonly known as tax reform or TCJA. And the TCJA, it transformed 174, so taxpayers could no longer immediately deduct their research expenses. And that applies to tax years beginning after December 31st, 2021. So I know there's some clients that I talk to, they've got a 9/30 fiscal year end and they extended their tax returns. So if that fits your fact pattern, then congratulations. You've got a few more months to hope that Congress comes through with either some kind of retroactive delay or hopefully the IRS issues more guidance than what we have now. So then one of the most common questions I'd say I get about this is, why did Congress do this? Why are they making us capitalize our R&D? And the answer is that R&D capitalization was a mechanism that Congress used to pay for tax cuts. So I think everyone knows the corporate tax rates went from 35% down to 21%. And also they used it to pay for elimination of the 20% corporate AMT, or alternative minimum tax. So there, near the end of the tax bill's negotiations, they had lowered the tax rate to 21%, but then they still had this corporate AMT rate of 20%. So something like that would have really diminished the value of any tax credits, really, if you can only take your tax rate from 21% down to 20%. So, kind of a last minute change was adding this in there to help pay for these things. And I think it raised about $120 billion in revenue over a 10-year budget window. So, and then also, since there was a 4-year period between when the law was enacted and then when it actually kicked in, so 2017 to 2022, a lot of people thought that this was going to go away. And there was plenty of time for Congress to act on this, to do something about it. And I include myself in there too. I thought this was going away. But fast forward, here we are. It's 2022 tax filing season. I think it just opened up the other day. And so we're stuck with R&D capitalization, and the US is now one of only 2 developed countries in the entire world with this type of tax policy. All right. So let's talk about some of the specific changes in 174. So costs that you incur for research performed in the US is going to get charged to a capital account, and then you spread those deductions over 5 years. On the other hand, if you incur costs for research performed outside the United States, those costs are going to get deducted over a 15-year time frame. If that's not bad enough, it also comes with a mid-year convention rule. So in practice, what the mid-year convention rule does is it extends that recovery period out another year. So instead of 5 years, it could be a 6-year recovery period. Instead of 15, it could be a 16 recovery period, 16 years. So just to walk you through kind of a high-level example, if you incurred $1 million in US-based research expenses, you'd only get to deduct 10% of that, so $100,000 in year 1. Then you get the next 20% in years 2, 3, 4, and 5, so $200,000 in each of those years. And then after that, you deduct the final 10% balance, or the final $100,000 in year 6. So it's not great news if you're used to deducting everything in that first year. If you had $1 million, you're used to deducting that million in year 1, and now you're getting a $100,000 deduction in year 1. So we're looking for silver linings, and if there is one, I'd say that if your research spending is relatively stable over year to year, over an extended time period, then your deduction should even out after a while. So when I do the math on this, I'm showing like maybe a 6-year time frame when it starts to even out. And the reason that is because you're always getting that small deduction in year one, but then as you proceed through time, you're also getting those prior year deductions that start to pile up. So another significant change here is that, and we're going to talk about this in more depth today, but all software development costs are now considered 174 expenses that need to be capitalized under this new regime. So it's not just software development expenses that have uncertainty, it's any software development expenses. So moving on, and when we talk about 174, that's a federal tax law, so that applies to your federal taxes. But there's also many other states that conform to that federal law. So in that case, you'd have to factor that into your state taxes as well as your federal taxes. So we wanted to pull up this slide and show you which of the states have conformed to the new R&D capitalization regime. And so we pulled this list back in November, so just a few months ago. But I do think it's important that you double check these states before you file, because in my experience with the states, the laws can change very fast. So I don't know if any of the state legislatures have made changes to this in the new year, but that's something you'll want to look into. But right here, we're showing that there are a total of 8 states that do not conform to 174. So if you're doing research in one of these states, a state that's listed here, then that's good news for you. You won't have to capitalize. Now, if you're doing research in a state that's not listed here, maybe not so good news. And so this is a pretty big issue we wanted to make you aware of. All right, now, wanted to also provide you with just a brief legislative update. So the 117th Congress, that's the Congress that just ended, January 3rd was their last day. And then the 118th Congress came in after that. So last year, they introduced several high-profile bills that would have either repealed or delayed R&D capitalization. So think about like the Build Back Better Act that received a lot of press. That didn't make it across the finish line. And there was also the CHIPS Act. There was a multi-year delay of 174 included in that bill, but it got pulled out last minute before that one passed. So, and there's others too, but none of those bills that included a 174 extension or delay or repeal, none of those made it across the finish line. So, we're keeping a close eye on this all the way up through the end of the year when the big budget reconciliation bill passed. So it didn't work out, didn't happen. Historically, though, the R&D credit, 174, just R&D incentives in general, they've always enjoyed very broad bipartisan support in Congress. And I would say even last year, there were bills introduced in both the House and the Senate that would have fully repealed the changes to 174. And if you look at the House bill, there was over 100 co-sponsors, I think 110 by my last count. And then if you look at the Senate bill, I believe somewhere around a third of the Senate co-sponsored that bill in the Senate. So a lot of bipartisan support. There's just a lot of political dynamics right now that have prevented a fix to 174 over the past few years. And I'd say at this point, there's a lot of uncertainty whether or not this is going to get addressed in the new Congress. But we have seen a lot of positive comments from members of the new Congress. And what they've said is that addressing 174 is a very high priority issue for them. So with that said, that's a legislative update, but also just in terms of guidance, the IRS did release some guidance at the end of 2022. And that guidance was around how you formalize your change in accounting method to conform with the new 174. And so we're going to talk about that in more detail towards the end of the presentation. But in terms of other guidance, there is more substantial technical guidance that's expected to come, but we're not exactly sure how or when that's going to happen. IRS made some comments last year that they plan to issue substantive guidance along with the change in accounting method guidance last year, but that didn't happen. I've seen other news where they've talked about releasing additional guidance mid-year this year. And then I've also had some personal discussions with the Chief Counsel's office, and what they have told me is that there's a regulation in the works. They've actually opened up a regulation project. They've assigned it a regulation ID number, and even it hasn't been posted to the Federal Register, but that's something that we're expecting to see soon. And if this is the route they take, issuing guidance in the form of a regulation, that's a process that can take a lot of time. There's a lot that goes into a regulation. So if that's the case, we don't expect any immediate substantial guidance. So doing the best with what we have for now. Also in my discussions, of course, there's no commitment to any kind of timeline on the regulation. All right, so I'm going to hand it over to Emily to tackle our first polling question.
All right, our first question today. Did you factor your R&E expense capitalization into your estimated tax payments? And your options are A, yes, B, no, or C, not applicable. We do not have any prior R&E expenses. So we'll give everyone a moment to think on this. To participate in our polls, please click the button next to the answer you choose and hit submit. If you have any difficulty seeing the polling questions, you may refresh your browser. We'll give everyone another moment here. Still have some responses coming in. All right, let's go ahead and see what everyone has to say. Travis, back to you.
All right, so just evaluating the results here. It looks like the most popular option was yes. So these people were very conservative, or maybe they had a crystal ball and knew that 174 wasn't going away. But there's also a good chunk of people that did not. And I would say a lot, I'm not sure what the percentage breakdown looks like, but I talk to a ton of clients every day that did not make estimated tax payments. And some of those companies could end up owing a good chunk of taxes here in the new year. So I assume option C is we have probably a lot of accountants on the line getting their CPE credits. So appreciate you answering the question. So moving on, I'm going to hand it off to Star. We're going to talk about 174 expenditures.
Thanks, Travis. It's really important to understand the history that Travis went over to really be able to digest the new changes and how they apply. One of the biggest questions that we get, and I guess people are hopeful that they can maybe, instead of calling it R&D, call it a general business expense or classify it in some other way, given that the expenses a lot of times could be either. That was probably the biggest change in 174 is the removal of the word may. Before you could choose, whether or not you said it was a 174 expense and isolated those costs and reported it as an R&D expense, or you could have classified it as another type of expense, capitalized it or expensed it as a general business expense. With the changes to the code section now, it makes it a requirement. So if it qualifies under 174, it's a requirement that you capitalize it. So you don't really have the ability to just call it, or something else or classify it as such. The actual code section doesn't really define what research or experimental expenditures are. It's really defined in the regulations. The code section itself is very short, and just basically says you have to capitalize R&D expenses. There is this addition now that Travis mentioned, that any software development expense also has to be capitalized. And really, that's all it says about software. There's very little guidance on what software development means or how, when it ends, what it encompasses. So our understanding now is that it would include both internal use software as well as any software that's going to be held for sale. So it's pretty all encompassing when it comes to software. This is the first definition of what R&D expenses are. Really anything that is in development in the experimental or laboratory sense. And it says it includes all costs incident to the development or improvement of a product. And so, it's very broad. Again, doesn't give a lot of guidance on where it starts or ends, and it is highly subjective, which will be, if you've played the R&D credit, you know that that's also subjective. It's a theme with both of these code sections, is it leaves a lot open to interpretation. And what is experimental or laboratory sense? It's basically if you have uncertainty concerning the development or improvement. And what uncertainty would refer to is, you might know you can bring a product to market that is possible, but if you don't know how you're going to bring it to market in a technical sense, how it's going to be designed, or if an appropriate method will work to get it designed, then you have uncertainty. Again, subjective, but pretty all-encompassing at the same time. Whether or not it qualifies as R&D is kind of a level of improvement or the nature of the product. It's not really whether or not it's successful or how easily it ends up being successful is irrelevant. So if you get it right on your first try, your first design, it could still qualify for R&D. If it takes several attempts, or you have to, go through several prototypes, for example, it would qualify as R&D until it is ready to go, to market, till it meets the basic functional requirements of what you are trying to do. Even if it is being, production's beginning, but you're still improving it or making changes, test production runs we see pretty frequently, it would still be considered 174. What is a product? This is a key concept. I tend to think of product as project, or use that term project, because it doesn't just refer to actual products. It can refer to a pilot model, a process, an invention, a formula. As you see the list here from the code, it's pretty much any type of development effort that you do as a business. And pilot model was a newer addition to 174 that basically allowed for any complete prototypes, even if the prototype ends up becoming the production model, that it would still qualify under 174. At the time, it was a positive change, because it meant that if you are designing and building a piece of equipment, customized equipment for use in your business, for example, there was uncertainty as to what extent you could expense those costs under 174 and how much you had to capitalize. And the definition of pilot model really allowed taxpayers to have a position to expense the entire cost, of the equipment if it was eligible in the year that the expenses were incurred, as opposed to capitalizing it. So at the time, it was a very positive change. And now with the capitalization, it's back to being capitalized, I guess, which was kind of the conservative approach prior to the addition of this pilot model section of the code. And if the requirements are not met at a project level, like the entire, so take that piece of equipment, if it's not if you buy an off-the-shelf piece of equipment, for example, and then you customize or add modifications to that, the off-the-shelf piece of equipment is likely not considered R&D, but any of those modifications or customizations could be considered R&D under 174. So this is really just getting at, you have to look at it component by component, even if the entire thing doesn't qualify as a whole. The costs include everything incident to the development or improvement of the product. So we're still, we need more guidance on what that means. What are all cost incident? But for example, I think you would no wages or labor would be included in this, and materials and subcontracted costs. Those are all costs that can be specifically attributed to an R&D activity. But in some of the examples of the regulation, there's costs such as depreciation allocation or a utilities allocation that also ends up getting included. And this is still to be determined how we figure that out. It really does vary. We'll go through some industry examples later, but it really does vary from industry to industry and taxpayer to taxpayer on what that might mean. Sometimes that's nothing, and you don't have to go to that level, and other times we're likely going to have to go to that level to allocate costs. It also includes the cost of getting a patent, not obtaining a patent from someone else, but actually if you're going for a patent for your research, it would also include those expenses and attorney's fees in doing the patent application. There is a list of what is not R&E. So there's not really a list of what is fully, but there is a list of what it is not. Any quality control expenses, efficiency surveys, management studies, consumer surveys, advertising and promotions, acquisition of another patent, or any research in connection with literacy, historical, or similar projects. So this is really just any activity that surrounds R&D but is not directly attributed to it, would not qualify. Also, if you the acquisition or improvement of land or property that is used in R&D. So for example, if you have a prototype lab or a prototype, we have some clients that have a small batch testing process, and they'll have equipment for that. The equipment itself isn't considered 174, although it would likely be capitalized anyway. But the allowances for depreciation on the equipment would be considered R&D. So if it's used in an R&D setting, then the depreciation related to that equipment would also be included in the 174. So you basically recapitalize depreciation and amortize it again. This is still, again, an area that there's a lot of uncertainty, that we have a lot of uncertainty. Sometimes it is very obvious if it is a specific R&D activity, but more often it's a mix of equipment and tools that are used for both R&D and non-R&D purposes. So how you allocate the depreciation to the R&D activity it really does vary, and we're hoping that we get more guidance on that to make it to simplify the process. The example in the regulation does include an allocation, so it's evident that was the intention, is to allocate it, but there's no real definition on how or the method of allocating it. That brings us to our next polling question: true or false? Patent attorney's fees may be eligible for 174 expenditures. So, sorry, turn it over to you, Emily.
No worries. We'll give everyone a moment to make their selection here. And as a reminder, if you would like to receive CPE credit for today's webcast, you'll need to respond to at least 3 of the 4 polling questions, and we are on our second question. So just another moment here. All right, let's go ahead and take a look at the results. Back to you.
Most of you got this correct with true. Patent attorney's fees are generally included in the 174 expense calculation. The way it's worded here, where it says may be eligible, we're used to looking at R&D expenses under 174 as a positive because you can expense them. Now it's kind of patent attorney's fees are required to be capitalized under 174 would probably be a better question, but the answer is true. With that, I will turn it back to Travis to cover what the difference is between the R&D expense code section and the R&D tax credit code section.
Thank you, Star. So again, like I was talking about earlier, we're shifting back and forth between code sections, but wanted to kind of lay out each one for you. We will have like a side-by-side comparison here in this section and help explain some of the differences and similarities. So that's what we're doing in this next section. And moving on to the next slide. Okay, so as we discussed, Section 174 outlines how you account for research and experimental expenditures. And that definition of research expenses is very broad. Star brought it up. It's anything that's incidental to the research. So that's a term that can apply to a lot of different things. And I've even went back and looked at the dictionary definitions of incidental, and even some of those vary between different dictionaries. So I think the biggest takeaway there is incidental can be interpreted to be a lot of stuff. So Section 41, on the other hand, so it's a tax credit that's based on its own definition of qualified research expenses. And the pool of expenses you can include for the R&D credit is much more narrow. It is much more specific. It includes expenses for, we say, qualified research. And the definition of qualified research actually points you back to 174. That's where there's some overlap in the rules. But the Venn diagram here, it's intended to illustrate this whole concept, illustrate that there is some overlap, but 174 is much more expansive. It's also worth mentioning that capitalizing, Star alluded to this earlier, capitalizing research expenses, it's not optional or just for taxpayers who are claiming the R&D credit under Section 41. Under this new regime, this is something that you're required to do, whether you're claiming an R&D credit or not. All right. So for those of you that are familiar with the R&D credit, Section 41 has its own definition where activities, they have to meet this, we call it the 4-part test. You have to meet all 4 of those requirements to qualify for the R&D credit. And one of those tests, it's not here on this slide, it's the uncertainty requirement. And that requirement actually originates in the Code Section 174 regulations. And to qualify under that requirement, it says that information available to the taxpayer does not establish the capability, method, or the appropriate design of a new or improved product. That's verbatim what it says. And so that comes directly from that 174 regulation. Now, the term product also has its own definition, and that can include things like product, process, software, techniques, formulas, inventions. So just don't think when I say product that means you're manufacturing widgets. It can mean a lot of different things. So in Section 41, there's these 3 other requirements that we've outlined here, and those don't apply to 174. So the takeaway is that, again, the pool of costs that you're required to capitalize under 174 is much more expansive than the costs you might be picking up for your R&D credit. for 174, you don't need to satisfy this technological in nature requirement or the process of experimentation requirement or qualified purpose. You only need to satisfy that uncertainty requirement unless it's software development. All software development is now 174. And moving on here to the next slide. So kind of picking up on that whole concept, we wanted to highlight some of the other similarities and differences between the two code sections. And so section 174, section 41, they both have their own lists of excluded activities. And those lists, they're different, but there's a lot of overlap. And so this list we have here is from section 41. These are things that don't qualify for the R&D credit. And one of these that I'll point your attention to again is software. And so in section 41, if you're developing software that's purely for internal use, then it has to meet a whole nother set of requirements to qualify. We call it the higher threshold of innovation requirements. And these are pretty stringent requirements that you have to meet to qualify an internal use software project. So 174 doesn't have that. It's, again, all software development. So you might have to capitalize those costs even though you're not getting a credit for them in section 41. So just leaving that slide here for a moment so you can kind of browse through and see where some of the differences are. And moving on to the next slide is this table that I talked about. And goal here is to illustrate some common costs that are usually incurred by a company that's performing any type of research and the proper treatment of those costs under 174 and 41. So as you can see, there's a lot of areas of difference, but there's a lot of areas of overlap. And so looking through some of these wage expenses for the R&D credit, you would take the box 1 W-2 wages only, and that's the taxable employee wages on this first line. Whereas in code section 174, you have to capitalize all of the employee wages, so which would include their non-taxable benefits. So they're really the gross wages, even things like payroll tax or any other employee costs that are allocated to employee salaries. So there's at least one instance where you could be including costs for the R&D credit that aren't capitalized under 174. And that's the line here that says substantially all wages. So the way that works, let's say you have an employee that's doing qualified research under section 41 and they're doing it 80% of the time. And let's say the other 20% of that person's time is on an activity like, let's say, production or maybe quality control testing. The production and quality control testing, that's specifically excluded from 174. But section 41 allows you to include 100% of that person's wages in the R&D credit. So get 100% for the credit, but in that scenario, only 80% gets capitalized under 174. And that's a pretty rare exception where you would get to claim a credit on something that's not capitalized under 174. Also, if you do an R&D study and you're reporting R&D on your financial statements, those could be really helpful starting points when you're trying to figure out what needs to be capitalized. But there's some cases where it's going to be straightforward, maybe smaller companies where you're doing pure R&D. But then there's also other cases where 174 can be a lot more complicated. It might involve a more complex, a more detailed analysis. It could involve reviewing contracts. You could be reviewing depreciation schedules. It might even involve interviewing your subject matter experts or the people who are actually doing the R&D to figure out what the right answer is. So, and these examples here are, a lot of them are coming right from the 174 regulation that Star had up earlier. And as you can see, I get a question a lot. Does this include indirect? Do I have to capitalize my indirect or overhead expenses or G&A? If you look through some of these examples, they are indirect overhead costs like utilities or depreciation or the attorney fees. Those could be considered G&A. So based on the guidance that we have today, the answer could be yes to a lot of those questions. All right, handing it over to Emily for our next polling question.
All right, thank you. Our third polling question, true or false? Section 174 requires the taxpayer to conduct a process of experimentation. And your options are A, true, or B, false. So we'll give everyone a moment to think about that. For those of you that would like a copy of today's slide deck, you may download that now from the slide deck and handouts widget. We'll also be sending that via email. Give everyone another moment on this third polling question. All right, let's go ahead and see what everyone has to say. Back to you.
So the correct answer here is false. So the process of experimentation, that's purely an R&D credit or a Section 41 concept. You do not have to engage in a process of experimentation to be deemed 174. And so unless your software development, again, all software development, it gets capitalized. So the only requirement in 174 is that you have uncertainty. So the other one, although thinking about this, it's like, how do you resolve uncertainties without going through a process of experimentation? But so the technical answer is B, false. And looks like most people got that one right. All right, then handing it over to Star. Talk about technical and industry-specific issues.
Great, thanks, Travis. And I see quite a few questions coming through the Q&A. I'm going to try and answer those in this section because a lot of it is related to things that we either need additional guidance for or we're still uncertain. Although, we've been anticipating there might not be guidance, so using what we do have and what we do know to come to some conclusions that are supportable is where we're at right now. And a lot of the questions coming through relate to these specific areas that there's just not a lot of guidance on. One thing to note on the 174 and 41 comparison, Travis mentioned it, but there is a link in the sense that in order to claim the credit on certain expenses, those expenses for the most part have to be included as 174 as well. So the section 41 for the credit says it needs to be 174. There are some exceptions because, as noted, there's differences that are between 41 and 174. So there are some issues that are R&D credit only. Here's the running list of the biggest issues that we've seen where we need additional guidance or we are developing positions, helping clients with positions because it's just unknown. One big one, what is the extent of this incident to, and what could be still considered cost of goods sold or general business expenses, etc., or under another code section. There's not a list, but there are some examples prior to this this code, the change in 174. You were able to elect to capitalize R&D expenses if you wanted. And so there is a regulation that deals with if you were to capitalize expenses, what would you include? And that's where we're getting the information for incident 2. And in that code section or in that regulation, there is a list of expenses. And so outside of their salaries and supplies, drawings is in there, heat, light, power, attorney's fees, and depreciation. So that's where we're getting that list, but it really is pretty comprehensive. So that's one thing we're really hoping to get guidance on, because it can be a really big hassle and burden for taxpayers to figure out. Also, what is the development of software? What does that include? And kind of in conjunction with the next one, what if it's contracted out? How is that included? And contract research providers in general. With R&D credit, we have the funded research kind of section that really defines whose R&D it is. 174 doesn't have that specific section, but it does talk about research on behalf of. So if you're working with a contractor and they're doing research on your behalf, that you would include that in 174. But that's a very narrow definition, and so we're not really sure what that means, what on behalf means. But to the extent where you can make a position that it's not on your behalf now, you might not have to include it in 174. But then you're also not able to include it in the credit calculation. So just to keep that in mind. Another one is, what is the proper treatment for intercompany expenses if you have two entities that are owned identical or in a controlled group? How does the intercompany transactions work? With the R&D credit, we have guidance on that area that any intercompany funding is disregarded and the credit belongs to whoever is incurring the expense. But 174 doesn't have that. And so just on plain read, it would imply that you would have to capitalize it in both entities, which would be double capitalization. But we are doing more research to find positions that maybe that's not the case, that on behalf of language along with some other guidance may allow to really only claim it in one of the entities. Causes problems because then you have the credit possibly being claimed in one entity and the expense being capitalized in the other, and how the IRS would look at that, we're not sure. We also don't know what an IRS agent might be looking at in an audit. As always, with anything new, it's still unknown. The substantially all rule, and I think this is one of the questions as well, in the R&D credit calculation, if a person spends 80% or more of their time in R&D, then you include their wages at 100%. But the 174 doesn't have that same provision. So we are landing on that you would likely just include them at the 80% or whatever percent they are at, because it is a 41 issue only, but that is still uncertain. There's still some uncertainty around that. How you would treat pass-through income with a partnership if there's not guaranteed payments, or even if there is, with the R&D credit, you would include the pass-through income as well if the partner is involved in R&D activities. That would be their wages. We don't really know how that would play out in this setting, or how you would capitalize that. It's kind of it would cause some issues, so we really not sure exactly how that'll be treated. Another area that we're looking into is the research resulting in depreciable property that is used in a taxpayer's trader business. So an example of this would be that pilot model where a company designs and develops their own piece of equipment, for example, and then that's going to be used in the manufacturing process. But it's R&D in the meantime. It's a prototype, working prototype or pilot model. The code covers that, if you dispose, retire, or abandon the R&D, that you would still have to amortize it over the 60 months, but it doesn't cover if it becomes depreciable property used in your trader business. So why that would be important is if under the old rules, you could convert it at the time that it becomes placed in service. So you could say it's no longer R&D, it's now a capitalized piece of equipment, and could potentially claim the bonus accelerated depreciation on it. So we're looking into that more, and if we can get to a place that will help some taxpayers or clients with at least that And I want to leave a little time for questions, so I'll try and go through this really quickly while answering some of these questions that are in the chat. It really, how it applies to different industries and also taxpayers within the industries varies a lot. Sometimes there's very minimal effect of the capitalization, and sometimes there's going to be a great effect of the capitalization. So for example, in pharmaceutical companies or professional service firms, where you're typically expensing all of these costs as wages throughout the year, it's going to be a big impact because whatever is now R&D is going to have to be capitalized where it was completely expensed in the past. In other industries where you might be working an R&D project that's already being put into work in process or construction in process as a holding account until placement service, it's already being capitalized. So it'll just actually be capitalized as something else and amortization will start on it. So maybe less of an impact. And then we have a lot of industries and a lot of examples where it's mixed, which is going to be the challenge to figure out for 2022 on how you make sure you're not double capitalizing it and also getting the right expenses in the right place. And just touch briefly on, it's a pretty brief RevProc. The new RevProc, the only guidance that we have so far is just related to the change in accounting method and verifies that you do not need to do a change in accounting method or Form 3115 related to this change, as long as you do it in the first year. So as long as you do it in this year, it doesn't require that you include several kind of a statement attached to your tax return, and it has some requirements of what needs to be included and the reason for the change and to really comply with this RevProc. So that's good news. And that brings us to our last polling question. Turn it over to you, Emily.
All right, our final polling question. Costs paid for foreign contract research is A, not a Section 174 expenditure, B, a Section 174 expenditure capitalized over 5 years, C, a Section 174 expenditure capitalized over 15 years, or D, a Section 174 expenditure included at 65% and capitalized over 15 years. So we'll give everyone a moment for this final polling question. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window. And just another couple of seconds here. All right, let's go ahead and take a look at the results. Back to you.
Thanks, Emily. It looks like most people got this right. The answer is C. For any foreign R&D expenses, it is going to be capitalized over 15 years. That brings us to questions. I do see a lot of kind of questions in here that are pretty specific, and we can get back to you individually if it's really something related directly to your company. The one thing that I wanted to note is that, in the past, we've always looked at maximizing, R&D expenses in order to claim the credit, as much as possible and allowed by law. And this kind of changes that dynamic. There's a lot of gray positions with R&D that can go either way. And with 174 capitalization, it might be that you really evaluate the positions being taken and kind of figure out what you are really saying is R&D and what you are not. And so it does change just the approach a bit. So that's why it's probably important to work with your tax preparer and R&D specialist, hopefully, to just really figure out what's the best positions that put you in the best situation. But Emily, is it okay if I just go through the questions? Or
yeah, we probably have time for a couple. We can go a couple minutes over.
Okay.
You can go ahead if there were certain questions that you wanted to address, Star.
There's a lot here, so I'm trying to find one we haven't
I'll
addressed.
take one. I'll take an easy
Okay,
one.
good.
So there was a question about early on in the presentation, I said the US is now one of 2 developed countries that has this kind of tax policy now. Question was, what was the other country? And the other country was Belgium. So got the fun fact one answered.
Yes. Trivia knowledge. Here's one. Do AWS charges used for R&E storage need to be capitalized under 174? So yes, the short answer is yes. If they are related to R&D, they would be capitalized under 174. They're also eligible for the R&D credit as a computer leasing expense. You take one, Travis.
Yeah, I mean, we just have a ton of questions here. As Star mentioned, we'll try to get back to you on ones that we haven't answered. I think some of them were answered later in the presentation. Okay, here's one. Would redesign of a product for end-of-life parts be Section 174? I think the answer on that one is yes, although this is a tricky one because it may not qualify for the R&D credit. So it kind of depends. We'd have to get more information. But one of the exclusions from Section 41 is duplication of an existing business component. And so a lot of people would think reverse engineering. And so that might not necessarily qualify for the R&D credit, but that's not an exclusion under 174. So you may end up capitalizing those costs.
And I know we're at time, so I can turn it back to Emily. And like we mentioned, we will go through the questions and get back to people individually on their individual questions that we did not answer.
All right. Thank you so much, Star and Travis, for a great presentation. As you both mentioned, we had so many questions come in, and we'll be doing our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you can complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to allow you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here's a link to an online survey where you can provide feedback for today's presentation. Please do take a moment to complete this survey as your feedback is very important to us. Thank you all for joining us, and we hope you'll join us again next time.
Thank you.